Hello, everyone. Welcome back to the Weekend Charts. I'm your host, Charlie Bilello, bringing you the most important charts and themes that I'm seeing today in markets and investing. Big show today. Make sure you stick around to the end. And if you're watching this on YouTube, take a moment, hit that subscribe button for more content just like it. And if you're watching this looking for a second look on your portfolio or your financial plan, reach out to us today at creativeplanning.com/Charlie. I'll have a link to that in the show notes. You'll get a free wealth path analysis from us where we're going to give you a portfolio checkup. We're going to give you proactive tax strategies, insurance and estate planning review, and so much more. So reach out to us today at Creative Planning. We do everything in-house, including, as I said, tax preparation. Our over 300 CPAs work with our wealth managers to make sure you minimize taxes paid and you maximize returns. At Creative Planning, we're not only a wealth manager, we also do insurance and estate planning. We also do services for business owners, and we're a family office as well for all. So reach out to us today at creativeplanning.com/Charlie. At Creative Planning, we're in all 50 states, so we likely have a location right near you. Over 350 billion in assets under management and advisement, and we're here to help. Okay, so what are we going to be discussing today? So much going on in the markets. We'll have to start out with the end of a historic uptrend. That would be the NASDAQ 100. We'll dig through that. There will be drawdowns. We're learning that once again this year. We're seeing the first correction since last August. That has translated into a sentiment shift, so we're starting to see the retail investor get a little bearish here. Diversification is back. This is a huge story in markets underneath those big drawdowns. In the U.S., we're seeing outperformance from international stocks and value stocks. Nvidia, big earnings report. Earnings were way up as expected, but interestingly, the stock has gone down since it reported earnings. Number 6, a growth scare. That's the big question. Obviously, with tariffs and Doge front and center, we'll discuss that. The record trade deficit. So we have final numbers for 2024. We'll dig into that, and we'll end, as we always do, with something positive, and that will be falling real-time inflation data. Okay, so let's start out here with the end of a historic uptrend. I've been talking about this for quite some time. This was the second longest uptrend in the history of the NASDAQ 100 index, and it came to an end this week with the NASDAQ 100 closing below its 200-day moving average for the first time in nearly 2 years. So you have to go all the way back to March 10th, 2023 to find the last time the NASDAQ 100 closed below its 200-day moving average. It did so again this week. And here's the table chronicling those long uptrends in history. You could see number 2 cemented in place, and you could see the enormous gains that the NASDAQ 100 had during this period of time. 73% increase with relatively little volatility and very few drawdowns over the past few years. So the big question is, of course, what are we going to transition to now? And if we dig back and look at some of these other periods, perhaps that will be instructive, perhaps not. Every time is different, but let's just run through it. In 2018, when this longest uptrend in history ended, you had the NASDAQ 100 continuing to push lower. There was actually a 20% bear market, which bottomed in December of that year. If we go to 2014, when that uptrend ended, you had a sharp rally actually out of that, and then the market would go sideways for much of 2015 into early 2016 until it exploded higher once again. If we look at 2022, of course, that was the start of the last bear market with the S&P 500. Eventually declined over 27% during that. So you definitely saw more downside there. And this was the big one, of course, in May of 2000. After the peak of the dot-com bubble, the NASDAQ 100 closes below its 200-day moving average and, of course, does not bottom until October of 2002. So every time is different. This time will be different as well. But clearly, as we've been talking about, the last 2 years were a huge outlier in terms of the smoothness of returns. And so investors, as we've been saying for a few months now, be prepared for more volatility, and we're finally seeing that now. Be prepared for more drawdowns. And speaking of drawdowns here, I'm showing you a list below the 52-week high, and you can see the magnificent 7 names here. Apple down 9%, Microsoft 15%, Google 17%, Amazon 17%, Nvidia 28%. So some sizable drawdowns off of the 52-week high. The S&P 500 about 7%, as we'll talk about in a little bit. Crypto getting hit as well. But if we take a step back and we look at what preceded this, these drawdowns are not huge or not surprising given what went on the last 2 years. So 2023, 2024, just enormous gains, enormous outperformance in these magnificent 7 names. Nvidia up 820%, Meta up 388%. You could see all of them outperforming the S&P 500, and the S&P 500 equal weight by a wide margin. So not unexpected at all. We've been talking about the valuations in these stocks being elevated relative to the market, and really their share prices outpacing the underlying fundamentals. So no surprise whatsoever to see this type of volatility. You don't have big returns in the market without big drawdowns along the way, and investors are learning this lesson once again. Okay, let's go to number 2. There will be drawdowns. This is one of my favorite sayings in markets, and that's simply the case that the market doesn't go straight up. You have these periods of volatility, of downside volatility, and the last 2 years we were spoiled as investors with seeing very strong returns and very few infrequent corrections. It's not that we didn't have any corrections, but very, very unusual to have back-to-back years here above 25% returns. It was actually the best 2-year performance for the S&P 500 since 1997, 1998. So very strong returns, and it shouldn't be surprised to see a moderation in these returns. We've been running for the first half of the decade here in the 2020s, 15% annualized for the S&P 500. Of course, historically, it's done about 10%, so running well above that, and a mean reversion is not surprising. And after 2024, where we hit 57 all-time highs, the 5th most of any year in history, we did hit 3 more all-time highs at the start of this year, but the backdrop was you have this enormous run higher, you have these high valuations, any sort of negative news was going to be used as an excuse to push it lower. And here's the valuation picture that we've been talking about. Trump entering his second term had the highest valuation for the S&P 500, starting valuation of any president in history, the CAPE ratio at 37.8. So we're seeing a little bit of a multiple contraction here during this correction. Nothing huge, nothing to write home about just yet. 7% decline here. You can see I'm listing all of the S&P 500 corrections that were above 5% off of an all-time high since the March 2009 low, and you can see just unbelievable resiliency in the S&P 500. It has snapped back every single time, and most of the time in short order. The one that took the longest, of course, was the 2022 bear market. But you can see these types of drawdowns are very common. Actually, if you go back the last 100 years, you tend to see about 3 to 4 of these types of pullbacks within the S&P 500, pullbacks above 5% in any given year. So not surprising. Now, as for the reason, what are people saying is the reason stocks are going down? Well, of course, if you've been watching the news, if you've been following it, everyone's talking about tariff fears. And now you have this slowdown, economic slowdown, concerns over that, as I'll talk about later. But is this the first time the market has sold off in response to tariffs? No, we saw it back in 2018. We talked about there was a bear market back then, and one of the reasons for that was attributed to the trade war and tariffs. Then we saw it in 2019 twice as well. So this is not new. Did the market recover from that? Absolutely. That 2018 bear market was erased within the first half of 2019, and then you had these 2 quick corrections in 2019. The market recovered. So the point being, we've seen this before. We don't know how it will shake out. There's always a reason in hindsight, but all of these pullbacks seemed like the end of the world at the time, and they ended up, of course, not being the end of the world. The market came back in the end. They got over all of these different fears, and usually a few months later, everyone had forgotten about it. And you probably forgot about the last correction in the S&P 500 with that Nikkei crash, and people saying the Fed was behind the curve, they should have been cutting interest rates, and you had recession fears. All of that was forgotten a few months later when the S&P 500 was pushing to new all-time highs. Now, so far this year, we are seeing signs of elevated volatility. So as compared to last year, which was a pretty benign year, we're seeing more frequency of these 1% down days, which I track here. 8 so far this year. The typical year has 29, only a little over 2 months into the year. So definitely running above average in terms of volatility so far this year. But the drawdown here, 7%, not huge in historical context. Actually, the median year since 1928, we've seen a 13% drawdown in the S&P 500. And even last year, which was a very benign year, we had an 8% drawdown on a closing basis. So definitely not huge at this point. And if you're a long-term investor in stocks, you should be expecting this pretty much every single year. The magnitude changes, but you should be expecting a pullback, and usually multiple pullbacks along the way. That's the price of admission. That's why you receive a higher return from stocks in the long run than safer investments like bonds or cash. Okay, let's talk about the sentiment shift here. Definitely a big swing if we're looking at sentiment. The VIX here creeping higher here, about 25, highest since last December. Not a huge spike so far. We'll see. I'm recording this on Friday, and we're seeing a little bit of an increase today as well, but nothing to write home about. When the VIX gets above 30, then you're starting to talk about extreme levels that it doesn't usually hit. But at 25, still, I would say not a huge level of fear. But if we're looking at individual investors, this was very interesting. Very quickly here, they've turned bearish. So if we look at this AAII sentiment poll, which is done weekly, and we look at the percentage of bulls in that poll, it's dropped to 19%, which is below 98% of historical readings. And if we look at the percentage of bears in that survey, we've seen that jump to last week, jumped over 60%. And that was the 7th highest reading ever. So very quickly, you're seeing sentiment shift, which is no surprise, as we often talk about. Most investors, I'm sure that's not you, but most investors tend to do the opposite of what you should do. They get more bullish when stocks are rising and rising fast, and they get more bearish when stocks are having a correction, and they're doing that once again. And these are close to extremes for the AAII poll. And looking back in history, when you see the percentage of bulls really drop to these levels, what you tend to see historically is above average returns for the market going forward. So you don't want to see a high level of bullishness. You'd rather see a high level of bearishness. That's what we're seeing today, all else equal. This is not a foolproof indicator, but again, you're a better position to be buying today, of course, than a few weeks ago when the S&P 500 was hitting all-time highs. You at least now have some type of a discount. And if you look at some of those names within the Mag 7 there, the losses and drawdowns have been much bigger than the overall market. Okay, let's talk about diversification here. For years, a lot of people questioning the value of diversification because large cap U.S. growth stocks led by the Mag 7 have really outpaced everything else. This year, it's only a little over 2 months into the year, but we're seeing the exact opposite in terms of the growth stocks within the index and the Magnificent Seven underperforming, while things like European stocks here up 13.9%, international overall up 8.2%. You have bonds up a few percent as yields have fallen. Value stocks up close to 2%, and meanwhile the S&P is down 2%. The dollar index has given back all of its gains since the election, is down 3%. So that's helping your international stocks because things like the euro and the yen have appreciated. And growth stocks here, which have been far and away the best performing group over the last decade plus, are down 6% so far this year. And if we look at this table of global equity ETFs, you can really see the differential here. U.S. stocks down 2%, as we talked about. And Europe, you can see here, up 13.9%. So huge spread. Very rare to see the S&P 500 in these bottom performers over the last decade. We haven't seen this very often at all, so it's definitely something notable. 16 years of outperformance from the U.S. versus international coming into the year. And last year, we saw a really extreme outperformance with the S&P 500 outperforming everything else in the world by a wide margin. So it'll be interesting to watch to see if that continues. But for now, investors, if you have a diversified portfolio, should be comforted because other things are working, even though U.S. stocks and large cap growth stocks are not. Okay, let's talk about Nvidia. Big earnings. We knew they were going to be big. We knew they were going to beat expectations. They always beat, but interesting to see the stock's reaction since then. Let's run through the numbers here. Nvidia's revenue moved up to 39 billion quarterly. You could see it's almost insane what they've done quarter after quarter, increasing by billions and billions of dollars every single quarter. They're projecting for the next quarter to go up as well. First quarter of this year, they're projecting 43 billion, so another increase expected here. You could see the gains on a percentage basis still very strong, but definitely moderating. So 78% year over year was the increase on the revenue number. And if that next quarter comes in at 43 billion, that year over year increase will drop to 65%. If we look at net income, just absolutely stunning. You could see only a few years ago they were at 3 billion in net income. Now they're at 22 billion. This is quarterly net income. That's up 80% year over year. And if we look at net profit margins, this is absolutely insane. Nvidia is probably the company that they'll write textbooks about in terms of pricing power during this AI boom, AI revolution. Nvidia has pretty much been able to charge whatever they want because they've had over 90% market share. And you could see that in terms of their net profit margin increasing. Despite this enormous increase in revenues, they have not suffered with declining profit margins. They're actually seeing the opposite, profit margins going up. So record 56% in 2024, following a record 49% in 2023. Just absolutely stunning. And the big question, of course, and I've raised it, is, well, how long can Nvidia maintain these unbelievably high margins before competitors start to come in and undercut them? So far, there doesn't seem to be an indication of that. Obviously, the expectation from investors is very, very high for Nvidia, leading to these high valuations that we've been talking about. But this is going to be the big question for 2025. Can it maintain its profit margins, and can it maintain that high growth rate that investors are expecting? And the interesting thing is not the news, because we knew Nvidia's earnings were going to be unbelievably good, and they were, but it's the reaction to the news, and investors so far are selling Nvidia on that good news. So it seems like a lot of that news was priced in at this point. 26% drawdown so far off of the all-time highs that it had last month. And if we're looking at the big reason for this, I'd say number one, it's not the underlying fundamentals, it's the valuations coming in. It leads you susceptible. And we've been talking about how Nvidia's fundamentals have improved dramatically, but its valuations have actually increased within that. So even though its revenue, its net income has gone way up over the past few years, its stock price has outpaced those gains, leaving it vulnerable. And you're just seeing here simply a mean reversion in terms of valuation, now trading at 21 times sales. You can see last year, well over 30 times sales. So definitely a pullback in this valuation. And as the growth rate slows for Nvidia, you're likely to see this continue to trend lower. The question will be, how much lower, and can it maintain those profit margins? Obviously, that's why it's justifying still a significantly higher price to sales ratio than the overall market. Okay, let's move to the U.S. economy. Is there going to be a growth scare here? First, I want to talk about the job cut announcements. This is an interesting report from Challenger Gray and Christmas. They do this layoff report every month. And so what they showed so far this year is 221,000 plus job cuts so far this year. That was the highest year-to-date total, so the highest total for January and February period since 2009. So, of course, we know 2009, we were still in the recession for the first half of the year. So interesting to see highest total since then. And what have the Doge impact? Has it been on this? Well, they said 62,000 of those cuts have so far come from the federal government. So definitely a big impact there. If you take those out, you're looking at a more normal level in terms of job cuts. So something to watch, interesting to watch. We don't know how deep these cuts are going to be from Doge, and perhaps, and most likely, they're going to be front loaded, and we won't continue to see these types of cuts, but something notable for sure. And the big question is going to be, in terms of the economy in the short run, what impact will the tariff announcements and really the uncertainty surrounding tariffs, what impact will that have on U.S. growth rates? And the Atlanta Fed puts out this estimate for GDP, and it's a very volatile estimate, so I wouldn't put too much weight on it right now. We're still in March here, but looking at first quarter GDP, their estimate really plummeted over the past few years, and they're calling, at least for now, for a 2% decline in first quarter growth. And why are they saying that? Well, if you look at the components here, they're saying that the exports, the net exports from the U.S., are going to go way down during the first quarter because of those tariffs. And really the assumption here, and we'll have to wait to see if it actually bears out, the assumption is that because companies in the U.S. are fearing these higher prices, well, what they're going to do is try to front run that by buying additional imports, and that imbalance is going to cause net exports to go down. So we'll see how much of an impact this has, and perhaps it's transitory in the sense that that will only be one quarter, and after that you'll see a more normal pattern. We don't know even if this data is actually going to bear out. This is, of course, just a forecast at this point, but I would note that many companies are obviously talking about it. This is the ISM manufacturing report, and you can see the number of mentions of tariffs in terms of the respondents here. It's almost every response is talking about tariffs. So that's the big question. What's going to happen there? Is there going to be a hit to growth? We don't know long term what's going to happen in terms of the rate, the duration. I'm going to discuss this in more depth with Peter Mallouk next week on our Signal or Noise show. But as of now, investors are starting to price in the idea that perhaps this could be a hit to growth. Okay, let's talk about the trade deficit. And really, this goes hand in hand with the tariffs. Is really, if you're in favor of the tariffs, you would point to something like this saying, well, we have this concept of free trade, but it's definitely not fair trade, and we should have reciprocal tariffs with other countries, because simply the deficit that we're running is unsustainable. It's not fair. Other countries are preventing our goods from entering their markets. They're putting tariffs on our goods, so we should do the same. And really the evidence here in terms of the trade deficit is pretty compelling here. $1.2 trillion deficit in goods for the U.S. in 2024. That was the highest trade deficit on record. And it's really balanced across many, many different countries. So it's not just one country that we're running this deficit with. You could see China still at the top of the list, although it's come down. The deficit with China was much higher a few years ago than it is today. But really other countries have taken the place. So other countries where manufacturing has shifted to places like Mexico and Vietnam. You could see now we're running huge deficits there as well. So China still at the top of the list, $295 billion deficit. Mexico, $172 billion. Vietnam, $123. Ireland, $87 billion. A lot of that's coming from pharmaceutical products. Germany, $85 billion. Taiwan, $74. Japan, $68. South Korea, $66. Canada, $63. And India, $46 billion. So you could see many, many different trading partners have this surplus with the U.S. And the question is, well, how should we respond to that? One possible answer is we're going to start putting tariffs in place to counteract these huge deficits, and that will encourage more production, more manufacturing capacity in the U.S., and just an increase in terms of this balance. But we don't know how much, again, the extent. And the real question is, well, does the U.S. have the capability to replace these goods today? So if they don't have this capability, that's obviously going to be a problem. Obviously going to have shortages, going to drive prices up. But if we have the capability to manufacture these goods and we're just buying them overseas because of this imbalance in tariffs, well, overall, in a few months, I would think that will start to equalize, and really the fears over tariffs will subside a little bit. But again, I'm going to discuss this in more detail next week on Signal or Noise, so make sure you look out for that. In terms of uncertainty, we haven't been in this place in a long time. This is an uncertainty index going back to 1985, and you can see here the spike is at a record high. And I would 100% agree with this because everything that's being discussed today is uncertain. We don't know if it's going to last a day, a week, a month. We don't know ultimately what the policy is going to be. So I would say all of this analysis in terms of what's the hit to GDP, what's going to be the hit to earnings, or what's going to be the impact, you can't do that because it's uncertain what the extent of these tariffs are actually going to be at the end of the day. So a lot of fear over it, just like there was back in 2018. But as we saw back then, the market recovered from it. The big fears over the tariffs and the trade war didn't end up causing a huge lasting decline in the markets or the economy. And perhaps that'll be, at the end of the day, that will be the same situation today. But as we stand right now, of course, very uncertain. On next week's show, I could be saying something totally different, which is why all of these forecasts and projections that you're seeing people make, just ignore them because they have no idea how it's going to shake out over the next few weeks, months, or year. So what I end, as I always do, with something positive, and that will be falling real-time inflation data. Trueflation puts out this real-time index where they're looking at year-over-year inflation changes, and they have a lot of different components to that index. So instead of CPI, they're trying to find more real-time data. And what they're saying is that the inflation rate in the US over the past year is actually 1.3%, which is, according to them, the lowest since December 2020. Obviously, we had that CPI report last month where it was showing 3%, showing an increase in prices. So this would be great news if it's actually true. That inflation is likely to come down, and we're seeing a number of different areas that look positive here in terms of energy prices coming down. We're also seeing rents in the U.S. continue to trend lower. They're actually down 0.4% over the past year. That was the 20th consecutive decline in asking rents. And if we look at shelter CPI, I suspect this is going to continue to trend lower because there's a huge lag between shelter CPI and the real-time data in terms of what apartments are listing for. So if we look at the best news out of today's jobs report, to me, it would be that wages are still going up. They're still up 4% over the past year. That's higher than the historical average. And the good news is if you have an inflation rate of 3%, that positive spread of 1% is leading to more money in people's pockets and an increase in purchasing power. So good news there. Hopefully that continues. Hopefully the next inflation report reflects what Trueflation is showing and shows a decline in the inflation rate. Okay, we'll end it right there. Thanks everyone for joining me on the Weekend Charts. If you're watching this on YouTube, hit that subscribe button for more content just like it. Have an awesome weekend, and I'll see you next time on the Weekend Charts.